I ended last video by asking you to do the calculate the IRR for these two projects. It's actually really easy to calculate the IRR if you understand how to do the NPV. You just put in the same information we put in when we were calculating the NPV. The only difference is instead of going into the NPV menu, right? Once you're done, instead of doing this step here and going in the NPV menu, you just go in the IRR menu, and from here you hit compute. Is that good? And that is going to get you the IRR. Okay. I don't have them calculated here. Well, I do in the later slides, but just put in these cash flows, right, in CF. Once these cash flow are put in CF, you just press IRR and then you press compute, and it's going to give you the answer what the IRR is. Is that good? I have them calculated here, as I said. For the second project it should be 14.33. For the first project it should be 11.16. Okay, and those are the discount rate for which I get a 0 NPV. Okay. I ask you to try to do the discount rate of 0, so you could also draw an NPV profile, which is what I've done here. Okay. Well, I actually didn't do that. I stole it from the textbook, if I'm completely honest. I have different discount rate, right? And I found the NPV for project A. I have different discount rate or cost of capital, and I found the NPV for project B. Okay, and then we can draw these points on a graph, and we can see what the NPV profiles look like for both of these cases. Okay. So yeah, that's just drawing the NPV profile. In an exam, I'm unlikely to ask you to draw an NPV profile. I've actually asked it in an exam before, and when I do, I don't know how it's going to work with you guys. I'll have to talk to you about it because you can't draw on D2L. But when I've drawn before, I've asked students to draw it before. Usually I would just ask them to include some important points, like the way I phrased it the last time I asked it, if I remember correctly, is I asked the students to draw the x-intercept and the y-intercept, right? So draw this point, find this point, and find this point. A lot of students struggle. It's really easy if you understand what the NPV profile does, right? This is the cost of capital here. So this point here and this point here are when the costs of capital, right, the interest rate you use in your NPV calculation is 0. These point here and this point here are the IRR, so you just have to calculate the IRR, and then you can graph it using these 2 points. Okay, so I've asked that before. It's probably important you know. I may ask you to do that somehow for the exam. Okay, I say somehow because I know you can't graph on D2L again, right? So that's just the IRR, showing the IRR profile of these 2 cases. In this specific case of these 2 projects, in this specific case, there's actually no problem. You can actually use the IRR to decide which project to do, because the project B that has an IRR of 15% is always better for any cost of capital, right? If I was to draw a vertical line here that goes straight up, right? The project B always has an NPV that is higher than project A, and that's true at any interest rate. So it really doesn't matter. Whoops, that was supposed to be a straight line. The blue line is always above the green line, so it really doesn't matter. We could, in this specific case, use the IRR to choose which project we want to do. I introduce here a different project. Okay, this different project starts with a really big cash flow in year 1. And then the cash flows drop really quickly. Okay, we can draw the NPV profile for B and for C, and if we were to do that, this is what we would find. Okay, why is this problematic here if I use the IRR? Okay, can anyone just stop this right now and think about it? Why is it problematic to use the IRR in this case? Okay, the answer is that if you use the IRR to compare these 2 projects, it would always appear to you like project C is better. right? The IRR for project C is higher, so project C seems to be better. Okay, and that's true if the cost of capital is 20%. If the cost of capital is 20%, the NPV for project C is positive, and the NPV for project B is negative, right? So project C is better. That's also true if the IRR is about 12.5. If the not the IRR, sorry, if the cost of capital is about 12.5. If the cost of capital is about 12.5, the NPV for the blue project, or for project B, is here, and the NPV for the red project, project C, is here. The NPV for project C is bigger than the NPV for project B. We should do project C. Okay? So for some interest rate, choosing C is the right decision. Okay, for some cost of capital. But suppose instead our cost of capital was 5. Our cost of capital is here. Which of these two projects is better? B or C? Well, C has an NPV that is here, and B has an NPV that is here. The NPV for B is bigger than the NPV for C. We should do project B. Does that make sense? The problem, right, this is coming back to my third problem from using the IRR, right? The problem with using the IRR to compare projects is that if the two NPV profile cross, if the two NPV profile cross like they do here, it is not clear which one of these two projects we should do. Okay, as long as the NPV profiles do not cross, using the IRR is totally fine. But if the NPV profile does cross, then it's a problem. Okay, why does the NPV profile cross here? Can anyone tell me? Can you look at these cash flow and tell me, Francis, I think that's why these two projects cross, right? The NPV profile for these two projects cross. Okay, it should be relatively straightforward to see. Where are all the cash flow for project B coming from? Project B is backloaded, right? All of the payments for project B are towards the end of the project. Okay, all these projects early on don't really mean a big thing, right? Compared to the 10,000 towards the end. Project C is front-loaded. Much of its value is in the beginning of the project. For the same reason I explained earlier, I think it was in the previous video, because project C is front-loaded, much of its payments come at the beginning, right? This 9,000 is not as affected by changes in the interest rate as these two $5,000 here, because they're further in time, and change in the interest rate will have a bigger impact on these. Does that make sense? This leads to an issue, right, where project B, because it has really big payments at the end, when the interest rate is low, project B has a really high rate of return, because all of the payments are at the end of the project's life, and interest rate has a big impact on it, when the NPV profile will be slope downward faster than the other project. It's going to go down really fast. The other one, project C, because it's really front loaded, doesn't have a really big NPV when the interest rate is low, but the NPV will go down slower because it's not as affected by changes in the interest rate as project B, and that's why we're going to get this crossover. Okay, here it says the crossover point is 9.3. I can ask you in the exam to find this crossover point. How would you find this crossover point? Got an answer? Yep. It's actually really easy. Basically just think of this red line as being your x-axis here, right? Basically we want to find where this blue line crosses the red line. If we think about this blue line as our red x-axis, it actually kind of makes sense. That's what we're trying to do here. That's the IRR, right, of the blue project minus the red project. Okay, so basically what you do if you wanted to find this crossover point, I'll do it right now actually because I'm not sure everyone will follow. If we want to find this 9.3 where these two projects cross, and I'll just go here so I can see. What we would do is we would put the cash flow in our calculator like we do for finding the normal NPV. but what we would do is we would take the cash flow from one of the project minus the cash flow of the other project, right? So what would we put in CF0? We would put $0. Why? Because we would put minus $10,000 for project B minus 10,000 for project C. That's 10,000 negative plus 10,000 positive. That's 0. What would we put for C01? For C01, we would put the cash flow from project B, 1,500, and we would minus the cash flow from project C, 9,000. 7,500. What would we put for cash flow 2? I'm asking that of you. Can you tell me what I will put in C02? Should be hopefully pretty straightforward. I'll put 2,000, the cash flow from project B, minus, if you're not seeing where I see those, by the way, they're right here. This is why I often leave my slides open, because I can reference the previous slides or the next slide, right? So what would I do is I would take the 2,000 from year 2 project B minus the 3,000 for year 2 project C. That would give me 1,000 negative, and I made a small mistake up there. I know you were all yelling at your screen telling me, Francis, this should be negative. You won't get the right answer. You are totally right. C03, what would I do? 2,500 minus 1,200 would give me 1,300 positive. Okay, and I just keep going like this. I'll stop the video right now because hopefully you understood. But I'll just do it on pause. Okay, if you put this information, I just added the last 2 lines here on pause, right? The last cash flow is 5,000 minus 0 and 5,000 minus 0, and it repeats. So it's the same cash flow, repeats twice. Okay, if you put this information in your calculator in the cash flow section, you go to the IRR and you can't compute this IRR, you're going to find the crossover point where these two, I won't call it the IRR because this is a crossover. The crossover is 9.3%. So when the interest rate is, or the cost of capital is 9.3%, we would be indifferent between these two projects, right? Because their NPV is the same. Okay, below 9.3 we would prefer project B because the NPV profile is higher for project B. Above 9.3% we would prefer project C because the NPV is above. Okay, this makes me realize that I didn't talk about this before now in this video, but hopefully it's pretty clear by now that you should always pick the projects that have a positive NPV, right? And you should pick first the project that has the highest NPV. Yeah, I don't have a slide. I'll just talk about it later. I'll make a slide about it later, and I'll talk about it later too. Okay, I have some more things to say about that in the NPV. Okay, so I just went and wrote the slide because I realized I forgot to say it. Basically, if we don't have budgeting capital budgeting constraint, and if the projects are not mutually exclusive, we should always do all of the projects that have a positive NPV because they're all going to create value for the firm. Okay, normally we shouldn't find that many projects with positive NPVs anyway. If you did Econ 103, you should have learned that projects with positive economic profits are pretty rare. Okay, the NPV calculates the economic profit. If the NPV is negative, the economic profit is negative. If the NPV is positive, the economic profit is positive. So in the real world, it should be pretty rare to find a ton of projects with positive NPV. Usually, if a firm finds that almost all of its projects have positive NPV, it's probably because its assumptions are a bit too generous, right? You have to make some assumptions in order to get these NPVs. So probably the firm is just a bit too generous in its sales forecasts and forecasting its costs, so on and so forth, so that it leads to having a lot of positive NPV. But you shouldn't be finding like millions of positive NPV projects. If the projects are mutually exclusive, we usually would take the project with the highest MPV. Projects are mutually exclusive when you can only do one of them, right? Suppose you need to buy a new truck. You could buy a new truck, right, that will last longer but is more expensive today, or you could buy an old used truck, right, that will be cheaper today but will require more maintenance over time. Which one of the two should I do? Well, if you only require one new truck, you won't do both. Okay, so you just should do the one that will give you the highest MPV, not both of these projects. Okay, that's the part I had forgotten to say. Okay, where was I? Okay, the next measure of tool we can use to choose between capital project is the profitability index. It's actually really easy once you know how to calculate the MPV. Okay, the profitability index, okay, is simply 1 plus the MPV of the project divided by the initial investment. Okay, so the MPV of the project divided by the initial investment tells me how much value it will create as a percentage of the initial investment, right? And then just adding 1 so that it's 140%, right? So if it's 1.4, it's just saying that basically this project will create a return of 140% of my initial expense on that project. Okay, so it's pretty easy to calculate. It's really not a big problem. Usually we want to accept projects if the MPV is bigger than 0. So we want to accept project if the profitability index is bigger than 1, right? This number has to be positive. If this number is any positive number, then this whole thing here will be positive, and this is going to be bigger than 1. On the other end, if the MPV is negative, right, the PI index will be smaller than 1, and we don't want to take the project. We don't want to do it. But I shouldn't have to talk about how to calculate that. It's pretty straightforward. I think you can go and try to calculate the PIs with the previous examples. Well, there's an example here, so we can do it. It's actually not that long at all. Okay, you can take a second to do it. You should be able to do that. Okay, so I calculated here. The PI for project A is just 1 plus the MPV of project A at 10%. That was just given in the table here, so it was pretty easy to calculate, right? 180. And I divide this by the cost of project A, which is 10,000, and we get the profitability index. Okay, if the cost of capital is 10%, the profitability index for project B is 1 plus the MPV divided by the initial investment. The MPV can be found here, investment B at a discount rate of 10%. The net present value is this, and the initial investment is 10,000. In case you're a bit confused here, just remember these are the same project. The initial investment was here at 10,000, but these are the same project that have been following us the whole time, right? I've been just keep using these two projects. So yeah, the initial investment was just 10,000, which gives us a PI of 1.1414. Okay, I'll just do the average accounting return, and then I will stop the video. Okay, the average accounting return is pretty straightforward, but it's not really used, and it's one of these methods that are not recommended by most people in finance to use. It's actually a pretty bad method. Okay, the first reason is it doesn't use the time value of money, right? Does not use the time value of money. The second reason is that it uses accounting flows and not cash flows. Accounting flows are not really relevant because they don't really tell us anything about the actual timing of the cash flows, right? Because we use accrual accounting, we don't actually know when we receive the cash flows by using accounting cash flows. Okay. The last reason is that there's no clear decision rule. With the IRR, with the MPV, there are real logical decision rule that are easy to follow. The MPV is positive, you do it. The MPV is negative, you don't do it. Here there's not really any real average accounting rate of return that it makes sense to accept or to not accept. There's no kind of cutoff points that are intelligent. Even the payback period has a really good cutoff points. It's like, actually no, the payback period, I also kind of have this problem. Is a payback period of 2.5 years fast enough? Or is 3.5 okay? Or is 4.5 okay? What is the best payback period? It's not really clear, right? So there's a little bit of that problem too with the payback period. But with the IRR and the NPV, we don't have this problem. There's a really clear decision rule. What decision should we make given the IRR or the NPV? Okay, so pretty straightforward. The average accounting profit is the average accounting return that is earned over the life of the project. What do? We'll take the average net income over the life of the project, and we'll divide it by the average amortization. Okay, the average net income per year and the average amortization per year. Okay, so here I have a project. Someone in accounting was nice enough, or even someone in finance was nice enough to calculate the earnings after tax, or the net income for me in this column. And the amortization cost that I will report for the capital asset here. Okay, here basically this is a $30,000, and that's not a $30,000 capital asset. Sorry, so this is the amortization I can charge for it for the first year. Okay, what I do is pretty straightforward. Is I just find my amortization cost for every year. I find my net income for every year, and I find on average over the 5 years what was my average amortization. Okay, so I just take all these numbers, these 5 numbers, I add them together, gives me $75,000, and I divide them by 5 because I have 5 years. Okay, the net income, I have 4 years of net income. I take these 4 numbers, I add them together, I get 16,000, and I divide them by 4 because I have 4 years of net income. You're always going to have 1 more years of amortization because you start amortizing earlier because you started spending the money on that project right away at year 0. Okay. An other way of thinking about this, because I'm always going to use linear amortization for these problems. There's a much easier way of finding this 15,000. It's a little bit the same thing we did when we were doing the inventory management. If we have linear, if something decrease at a linear rate, the average is always going to be half of the first value. Okay, it was the same with the inventory, if you remember correctly. The half of the EOQ, the economic order quantity, was our average inventory. So here, if I just take 30,000 and I divide it by 2, it's going to give me my average amortization, 15,000. Okay, and they're both the same way to calculate the same thing, and I think this method's easier. If you do questions in the book and they don't have linear amortization, it might be a little bit different, but in the exam I'll always use linear amortization. So you can just find the amortization for the first year divided by 2, and then you just do the average earning the way I just explained to you. Okay, once we did that, once we found the average earning, 4,000, the average amortization, 15,000, we just take the 4,000 divided by 15,000. We just take our average net income divided by our average amortization, and we get a rate of return of 26.7% on average. But we don't really know what that means. We don't really know if there's an important cutoff. Where should our cutoff be? Should we accept this project or not? There's no theoretical reason to say yes or no in this case, right? That's what I said earlier about no objective decision rules. Okay, I think I'll stop the video now because we're at 25 minutes, and I'll start the next material for the last video. And it's possible that's the last video for the week. I'm not 100% sure. Yeah.